So with these 3 rules that we have mentioned above will help you when it comes to the screening of property's potential, and you will be able to make a decision in less than 1 minute.
Just by knowing how much the property is selling for, potential rental income, and how much we're going to be spending for renovations, we can instantly determine whether it's worth our time or not.
Most beginner property investors struggle finding that right deal. So we end up wasting a lot of time when it comes to us viewing properties, a lot of money when it comes to engaging with estate agents, whereby we're searching for something that is not defined yet, or even worse, missing out on great deals that might be next door. Beginner property investors get lost when it comes to unrealistic expectations when investing in property, or analysis paralysis. Does that sound familiar?
But I have good news for you. These rules will assist you in cutting through the noise and just making sure that you're spending your time on the right deal. But remember, these are quick filters. They will not replace due diligence. They will save you hundreds of hours upfront and also save you a lot of money because you won't be making the wrong decisions.
So we have a question for you. Have you ever wasted a lot of money whereby you only found out later that was a cash cow? Let's break down these rules one by one, and we'll show you how we've used them in our past deals.
Some property investors think that the 70% rule is only for people that are using flip as a strategy. I got news for you. It also works for people that are using rental as their main strategy. The 70% rule says that you should be buying the property at 70% of its market value. Now, market value is also known as ARV, which is after repair value. Usually this means that these are properties that need some work on the property. So I'm sure you're asking yourself how to do the calculations. For example, if the ARV or after repair value is 1 million, we take 70% of the 1 million, which is 700,000. Then we subtract renovation costs, say 100,000. The offer that we should be giving is 600,000.
FYI, do not base the after repair value based on your emotions or what you think where the market is. We need to work on realistic prices of where that market is, and one way to find that out is buying a Lightstone report and looking at the history of that area. You're probably asking yourself, as someone who's using the rental strategy, why is this important for someone who's renting out? Remember something, the lower you negotiate is the more equity you have. So that if we bought a property for 600,000 that's worth 1 million, what we have in 400,000, that is equity. So equity could be used to refinance at a later stage, and a bonus on top of that is that, remember something, the lower we buy the property is the less we would be paying for our bond, therefore more cash flow. This could be good for our next deal because we can actually access the funds, or this could be good because we could then use that cash flow to show the bank that there is a business model for applying for further finances later on.
Negotiation is your best friend here. Sometimes the best deals are distressed sellers who need a quick way out. Have you ever walked into a fix-upper and thought to yourself, "Eish, this is too much work"? Maybe that was the perfect opportunity waiting for the right investor to invest in.
Rule number 2, the 50% rule. The 50% rule is applicable for the rental strategy. Most beginner property investors think that if the rental income covers the bond, I'm good. But that is not true. When it comes to the rental strategy, there are expenses that the owner does incur. Number 1, rates and taxes. Number 2, levies if it is in a gated area. Number 3, sometimes it can happen that the owner is taking water. Number 4, sometimes it can happen that the electricity is on the owner. Number 5, it could be effluent. Number 6, maintenance costs. Number 7, management costs. So we need to be aware of all these costs prior us buying the property. The 50% rule, what it states is that 50% of the rental income that we will be collecting will be going to all of these operational costs. So therefore, if our income in rent is 10,000, for using this rule, we can assume that the 5,000 will be allocated to our monthly operating costs. So where the danger is this is before paying your bond. If your bond and the cash flow is not in the other 5,000, this is a clear indication of a deal that you would want to walk away from. Second scenario, if your bond is then 5,000 and then we are applying the 50% rule, that means now our other expenses would then be 5,000. So in that case, you will be in a situation whereby you're breaking even. I do not want to be in a situation whereby I'm breaking even. This is a business and cash flow is important. If your bond is 6,000 and now we're taking the 50% rule into consideration. Remember, we did say the 50% is 5,000, and now if our bond is 6,000, what that means is then 5,000 plus 6,000 gives us a whopping 11,000. So the other 1,000, which is the difference, will be coming from your pocket. So if it's coming from my pocket on a monthly basis, basically this deal is cash flow negative. Again, this is not a deal that I would want to find myself in.
FYI, this is why a deal might look good on paper, but fail when you factor in real-world expenses, things such as your vacancies and also emergency repairs. Now here's a pro tip. Always budget for repairs, even if the property looks good or you're not having any issues at that time.
The last pro tip is that if there are any costs or expenses that can be pushed towards your tenant, as a landlord, this is something that you'd like to do. For instance, water, electricity, and sewer, because at the end of the day, this is what the tenant is consuming. So these are expenses that you would like to push towards your tenant. If it is prepaid or pay as per usage, that is best.
If you are finding this information valuable, please do set up a Zoom meeting with us. Let's have a chat one-on-one to understand that how can we assist you. Last but not least, the 1% rule. So the 1% rule says that the gross monthly income should be equal to 1% of the value of the property. So if the value of the property is 1 million, what we'd like to do is that we'd like to benchmark our rental at 1%, which is 10,000 on a monthly basis. So now in some areas, although the value of the property is 1 million, we can only charge 9,000 on a monthly basis for rental. Trying to push it up to 10,000 might leave you with vacancies. And yes, I know what you're thinking. It's just 1,000 rand. But if everybody else is charging 9,000, then chances are you also have to charge 9,000.
So in this scenario, what's happening is that you have overpaid for a property that might not cash flow positive, especially if you are using financing. Pro tip, use this rule for fast screening and always make sure that you do your due diligence when it comes to finding the right numbers of the property prices and the rental income before you buy the property. If you would like to position yourself better when it comes to rental properties, make sure that you watch this video over here.